Hi, and thank you for joining us for the first quarter market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strage. Well, the new year got off to a good start with the U.S. stock market up about 6% in January, but the market cooled off in February and March and is currently up about 3% year to date. Bond prices in the U.S. and abroad have recovered a bit year to date as bond yields have fallen slightly. We are recording this about a week before the end of the quarter for full disclosure. We received relatively good news about inflation and the economy in the early part of the year. The annual inflation rate fell to 6% in February, which was down from 6.4% in January. While the inflation rate remains stubbornly high, it was seen as a positive that the rate continued to drop every month since it peaked last June. Employment data was also positive, with employers adding over 500,000 jobs in January and 300,000 jobs in February. The unemployment rate remained extremely low at 3.6%, according to the U.S. Bureau of Labor Statistics. So with a strong labor market and strong consumer spending, the economy seemed to be on solid footing, and the stock market rose in January. The biggest focus for investors at that time was if the Federal Reserve would continue to raise interest rates aggressively to combat inflation. Then a largely unexpected set of events with the banking sector shook the markets. Silicon Valley Bank, which was one of the largest banks in the U.S. that funded technology companies, was adversely affected by many of these tech companies struggling over the past year. In addition, the bank took undue risk and was one of the largest holders of long-term bonds, which had significant losses as interest rates rose rapidly. After the bank tried to raise money by selling stock, its depositors lost confidence and fled. To make matters worse, the bank had among the highest rate of uninsured deposits, as many of its customers kept balances well above the $250,000 FDIC insurance limit. To help avoid a banking crisis, the FDIC announced that it would still guarantee all of the bank's deposits, even those above the insurance limit. Soon after, the FDIC stepped in to guarantee all the deposits of another bank called Signature Bank, which was heavily involved in the cryptocurrency industry. Two additional large banks, First Republic Bank in the U.S. and Credit Suisse in Switzerland, also came under intense pressure. Three major U.S. banks stepped up to deliver more cash to First Republic in an attempt to save it, and so far they have been successful. The Swiss National Bank tried to step in and help Credit Suisse before it was forced to sell to one of its rival banks, UBS Group. Let's take a step back and look at the bigger picture to try to see what is going on with the banking industry. We are in the middle of the steepest rate hike cycle in history. When interest rates rise, it can put more pressure on banks. Depositors are expecting more interest on their money, and borrowers can have a tougher time paying back loans at higher interest rates or if the economy slows down. Over the last year, bank deposits have fallen as investors are seeking higher interest on their cash reserves. At the same time, money market rates are historically high as they are offering much higher interest rates than most bank accounts. This has weakened bank balance sheets since they have less assets in the form of customer deposits. There are regulations in place to ensure that banks have sufficient reserves to withstand withdrawals and failed loans. After the financial crisis in 2010, the Dodd-Frank regulations set tougher safeguards on banks with more than $50 billion in assets. However, in 2018, Congress rolled back those requirements to only apply to banks with more than $250 billion in assets. So more of the smaller regional banks are less regulated and could be more at risk of failure. This all according to the Wall Street Journal. Investors have changed their expectations of how the banking failures will affect the Federal Reserve's plan to raise interest rates. They now believe that the Fed will soon stop raising rates and will begin lowering rates by the second half of the year to provide relief to both banks and borrowers. This could provide a boost to the financial markets and economy. At this point, it is difficult to determine exactly how widespread the banking trouble will be. However, we believe the current situation is much different than the financial crisis in 2008. At that time, bad mortgage loans and securities were highly leveraged and spread throughout the financial system. Now, most of the largest national banks seem to be well capitalized, and hopefully the crisis will stay relatively contained to some of the regional banks that took undue risk while interest rates were low. What can you do to protect yourself? You can make sure that the money you have at your bank is below the FDIC insurance limit of $250,000. If it is, then you can be confident that your money is protected and backed by the federal government. If your balances are above the insurance limit, we can discuss alternative options such as a money market fund of Treasury securities that likely offers higher interest with comparable safety. You can also try to make sure that your portfolio is well diversified, but we try to have that covered for you. We will continue to monitor the banking sector and broad financial markets, and we will make changes to our investment strategies as necessary. Hopefully this provides you with more clarity so you can worry less. Thank you for your continued trust in us, and we will see you soon, either in our office or the next quarterly video. Take care.